All right. Welcome, everyone, to another deep dive. Today, we're going to be talking about speculation.
Specifically, we're going to be taking a look at some excerpts from The Perfect Speculator by Brad Koteshwar.
So our mission for this deep dive is going to be to really get to the heart of Koteshwar's philosophy of trading, how to, as he puts it, win big in up markets and lose nothing in down markets.
Yeah, what's great about Koteshwar is that his perspective comes from real experience.
Oh, absolutely.
You know, he actually wrote The Perfect Stock. It dissected that crazy rise and fall of Taser International, which was, just an unbelievable run, 7,000% in a little over a year, followed by a pretty significant correction.
Yeah, 7,000%. That's just crazy, right?
Yeah. And on top of that, Koteshwar has firsthand experience as a broker.
Right.
So you can really see how those real-world experiences shaped his outlook on the market.
It's like he's been in the trenches, seen both the incredible highs and, the gut-wrenching lows. And throughout the book, there's this kind of constant tension between, the kind of desire we all have, right? Wanting those quick, effortless riches that the market seems to dangle in front of us versus the often, let's face it, the demanding and disciplined reality of what it actually takes to find success as a speculator.
Absolutely.
And a lot of that wisdom, a lot of that practical advice in the book comes from an experienced speculator named Boyd, whose insights are kind of woven throughout the book.
Right. You could say Boyd's insights are really the cornerstone of the book.
Okay, so let's jump right in.
Well, right off the bat, Koteshwar starts with this story about his barber.
Ed. Who's barber?
Yeah, Ed. And this guy is still working well into his 70s, even though he technically retired.
Wow.
And he explains that, he lost his retirement savings all in mutual funds during a market downturn.
Oh, that's tough.
Yeah, and Ed really regrets, not having listened to different advice, maybe sought out a different perspective.
Right, so it's almost like this immediate, personal regret that kind of sets the stage for Koteshwar's broader point about how we view the market, right?
Right, and Koteshwar goes on to talk about how the media, it focuses so much on the allure of those quick riches, the winning stories in the stock market. But you rarely hear about, the significant losses, the setbacks, even though those are probably way more common.
Oh, absolutely. Way more common, right?
Yeah.
It makes you wonder, right? Does that bias in the news, does that kind of warp our own perception of what's actually going on?
That's a good question.
Yeah.
So this kind of leads into Koteshwar's own journey, and he shares his experience with the publishing industry. So after he gets some attention in Time magazine about the whole Taser thing, big New York publishing houses are reaching out to him.
Well, yeah, everyone loves a good success story.
Right. They were all over his first book, wanting to hear about that dramatic rise of Taser.
Of course, of course.
But then things take an interesting turn. Koteshwar's second manuscript, he described it as covering these classic principles of investing, but in a very simple, clear way. And the publishers, they just weren't biting.
Really? Not even the little nibble?
Not at all.
What was their reasoning?
One publisher actually told him straight up, this book is not going to sell. And the feedback was basically, the public doesn't care about fundamental truths. They're not looking for easy-to-understand explanations.
What they want is that, that secret formula, the easy way to riches.
Exactly. The new way to get rich quickly. They want the hype. It doesn't matter if it's actually grounded in reality.
Oh, wow. That's kind of disheartening.
Yeah. And they even mentioned this author, Jill Incognito, who apparently sells tons of books by promising just that, instant wealth.
Well, there you go.
And Koteshwar mentions this inside joke in publishing that they love books that practically market themselves, the ones that dangle those unrealistic dreams of getting rich fast.
Yeah, it makes you think, right? It's so much harder to sell a book about true market lessons, the kind that require dedication, patience, a certain mindset.
It really does. It's almost like there's this inherent conflict between what really works and what people want to believe.
And you, as someone interested in, gaining knowledge quickly but thoroughly, how does that strike you? Is the promise of fast riches, is that something that you find appealing? And what we're learning here, what does this suggest about how realistic that actually is?
That's something to consider for sure.
Definitely. Okay, so Koteshwar then goes on to kind of criticize those approaches, the ones that, they highlight past successes. The whole, if you had only bought...
yeah, that was fun.
Yeah, if you'd only bought this stock, and then they try to, sell you their expensive services that promise to, help you find the next big winners.
Right, always chasing the next big thing. And he even quotes himself in the book. He says, the stock market's job is to seduce the naive with such lures of quick riches.
Yeah, I mean, I guess, to some extent it is.
It is. And the publisher even admitted straight up that selling that promise of easy money, that is easy money for them.
So it's like this self-perpetuating cycle.
It really is.
Okay, so then this is where this really important figure enters the story, Boyd.
Right, so Boyd's an older, very experienced speculator.
Okay.
And he's not doing well health-wise. He's got lung cancer from, smoking in the past.
What do I say?
And he decides to offer Koteshwar the chance to take over his stock market commentary.
Wow, that's quite an offer.
Yeah. And what's interesting is Boyd's reason for choosing Koteshwar.
Okay.
He liked how Koteshwar interpreted the market, straight to the point, honest and direct. And especially how he wasn't afraid to say what he thought, even if it might ruffle some feathers with those with some inside influence.
So it sounds like Boyd was looking for someone who shared his unvarnished perspective.
Exactly.
Someone who wasn't afraid to call it like they saw it.
Right.
And so what was Boyd's main focus? What was he trying to achieve with his market commentary?
Well, he wanted to make serious profits during bull markets. That was clear. But equally important to him was protecting his capital, avoiding losses during all those other times when the market wasn't, in a clear uptrend.
So kind of make hay while the sun shines, but also batten down the hatches when the storm comes.
Exactly. He really stressed that not every rally is the beginning of a bull trend. And the flip side, not every sell-off is the beginning of a bear trend.
Oh, I see. Yeah, it's easy to get caught up in those short-term movements and think it's the start of something bigger.
Absolutely. And Boyd, he believed in simplicity. He was really skeptical of those, complex mathematical models, the fancy software. Yeah. He even asked this question, if intricate math was the key to market success, why aren't mathematicians the ones, running the show on Wall Street?
That's a good point.
Yeah, makes you think. He saw the market as this thing that offers just enough rope to hang themselves to the public, the people who are always searching for those shortcuts to wealth.
Yeah, always looking for that easy path.
Right. But Boyd's approach, it was so straightforward, so simple. He said, if it's not obvious, if it's not clear, then the market's probably trying to trick you. And he cautioned against, chasing after those small, tiny gains.
Right. It's about those bigger, more significant moves.
Exactly.
So then what was Boyd's core belief when it came to actually, analyzing the market?
He believed in focusing on price and volume action.
Yep.
He saw that as, the most reliable information, the most unbiased.
So, I mean, if it's that simple, why isn't everyone doing it right?
Well, Boyd thought it was because humans, we kind of want to believe that market success, it has to be complex, it has to be difficult.
Oh, I see. It's like if it's too easy, it can't be true.
Right, exactly.
Reversing.
Yeah. And his most important lesson, the one he really hammered home, was first, do no harm. He believed that not losing is actually winning.
Yeah, protect your capital. It's rule number one.
Exactly. And he had this view on earnings growth. He said the market, it anticipates future earnings. That's what really drives things, not necessarily the actual reported earnings.
It's all about expectations.
Right. And he was also, wary of the big boys on Wall Street, those who might use, red herrings, misleading signals to kind of throw off the less experienced traders.
All right. So it's all about, being smart with your money, looking for confirming signs, not just blindly following what the so-called experts are saying.
Absolutely. So, seeing Koteshwar's potential, Boyd decided to offer him all this, his own, his knowledge of the market. He had boxes full of recordings of market cycles, his notes, his observations.
No, that's a treasure trove of information.
It is. And that kind of lays the foundation for all these core principles that Koteshwar lays out in the book.
So, how does Boyd approach this idea of speculation?
Well, one of the most important things he stressed was that speculation is an art, not a science.
Okay.
Science that relies on facts, proven theories, definitive conclusions.
Right.
Speculation, it's about observation, it's about acting based on probabilities. Every decision informed by the last. There's no absolute certainty.
There's always that element of risk.
Always. And he even cited a statistic. He said that only about 10 to 15% of people trading actually manage to, beat the market average in any given year.
Wow, that's a pretty small percentage.
It is, and that kind of reinforces the point that, success isn't about some rigid formula.
It's about being able to adapt, to read the market.
Right. Boyd actually thought that approaching speculation like it's a science, that can be dangerous.
Dangerous how?
It leads to losses. Because, we as humans, we crave certainty.
We want to be right.
Yeah, and it makes it hard to admit when we're wrong to cut our losses.
Right, to get out when things aren't going our way.
Exactly. But the speculator's mindset, he said, it involves accepting that you'll be wrong sometimes.
You have to be okay with being wrong.
Yeah, get out of those losing positions quickly, wait for those clear trends to emerge.
So then, what did Boyd consider a confirmed trend?
He said an uptrend, that's when you have a series of, higher highs and higher lows.
Okay.
And a downtrend, that's lower highs and lower lows. Pretty simple, but effective.
I see.
And he talked about zigs and zags.
Zigs and zags.
Yeah. And zig, that's the first sign of a potential uptrend, a higher high. And a zag, that's a lower low, the potential start of a downtrend. And he stressed that a speculator, you got to wait for at least one zig or zag before, really jumping in.
So you're waiting for that initial signal, that first indication that things might be changing.
Right. And then, once you see that first zig or zag, then it's about timing that first trade.
Okay.
And this is crucial, manage your money so that if you're wrong, you're not taking a big hit.
Right. So it's not about, going all in on that first hunch.
No, not at all. It's about confirming, is this really going in the direction I think it is?
So what was the overall approach then? What was Boyd's 3-step process?
He said, first, observation. Watch the market, watch the leading stocks.
Okay.
Second, interpretation. Figure out, what are the odds of this trade working out?
Right.
And then finally, action. Execute the trades, but always, always with protection against potential losses.
So always have that exit strategy in place.
Always. And he stressed that a good speculator, they rely on the market's signals, not opinions, not forecasts. And every action they take, it's guided by what happened before.
So it's like this constant feedback loop.
Exactly. Learn from every trade.
Now, this kind of brings us to, human psychology, right? How we as humans, how we approach the market. And Boyd noticed this thing, how people, they tend to, they kind of brush off warnings from experienced people.
Yeah, they don't want to hear the cautionary tales.
No, but they latch onto any kind of optimistic hype, right?
Oh, yeah, they love the hype.
Like he used the example of someone predicting, the Dow's going to hit some crazy high number.
Oh, yeah. Those bold predictions, those always get attention.
Always.
And he talked about this obvious bias, Once you've decided the market's going to go up, you start to believe it so much that, you can't see anything else.
You become blind to any other possibilities.
Exactly. And that just really emphasizes Boyd's point that you got to trust your own observations of what the market's doing.
The market's the ultimate truth teller.
Right. And that principle of Boyd's first do no harm, that becomes even more important when you consider, the average person just starting out in the market.
Right, because they're the most vulnerable.
They are. He said it takes a long time to recover from even, what might seem like small losses.
Those losses can really add up.
They do. And he pointed out that most people, entering the market for the first time, they're likely to be in a negative position after going through a full market cycle.
Meaning like an uptrend and then a downtrend.
Exactly. And a lot of people, they'll lose their money before that cycle even finishes.
Oh, wow. That's pretty sobering.
It is. And even those who, they might have some early wins, big gains, a lot of them end up giving those profits back.
So it's not just about, hitting it big once. It's about surviving those cycles.
Absolutely.
Right? So Koteshwar, he asked Boyd about this. How do you talk about the market?
Yeah, how do you communicate these ideas effectively?
Yeah, because people, they react in different ways. Some get emotional, some get defensive.
Right. And Boyd, he said, navigating the market, it's kind of like navigating human interactions.
Oh, interesting.
Because the market is really just the actions of everyone buying and selling.
Right, it's like this collective behavior.
Exactly. And Boyd recognized that while he was, pretty good at reading the market, at being right more often than not, he always knew he could be wrong.
Humility is important.
It is.
Yeah.
And he acknowledged that, it's the different opinions, the different perspectives. That's what makes a market.
So he used this rainbow analogy, right?
Yeah. He said people are always looking for that magic formula, that pot of gold.
Right.
They want it every day.
But that's not how it works.
No, not at all. And he compared those real opportunities, the ones with high probability, he compared those to rainbows. They don't happen every day.
No, they're special, they're rare.
Right. And he talked about how, Wall Street, the whole system, the tipsters, the brokers, they're always pushing people to buy, to generate transactions.
Because that's how they make money.
Exactly. There is a sale made available every day, he said. It's like this constant pressure to be active, even when it might be better to just wait.
And this kind of goes hand in hand with the idea of, waiting for confirmation.
Right.
Not trying to predict what's going to happen.
Right. Boyd, he didn't like predictions.
He cited a statistic that market forecasters, they're only right about a third of the time.
And even then, they often get the timing wrong.
So interpretation, that's what he stressed.
Right. Don't try to guess what the market's going to do.
Understand what it's doing right now.
Exactly. Based on what you can see, the price, the volume.
Okay, so what kinds of stocks was Boyd looking for?
He liked stocks that were making new all-time highs, but only during a confirmed uptrend in the overall market.
Okay, so during those times when the market's not in an uptrend, what was he doing?
Well, he said those are the times when, the younger growth-oriented companies, they're setting up their play.
They're getting ready for that next move.
Right. And he said it's important to be watching for the next big runner, but with focus, not trying to track everything.
Right, so be selective.
Yeah, he usually only focused on a handful of stocks at any given time. And his goal, his investing goal, was to double his money 4 or 5 times each decade.
Double his money.
Yeah. And then, importantly, to protect those gains. He gave an example, $100,000 could potentially grow to $800,000 in 10 years.
Wow, that's impressive.
It is. And he did that with just 3 successful doubles.
So it's about those big wins, those significant moves.
Exactly. And his philosophy was to focus on the younger, the less known growth stocks.
Yeah.
Because he felt like the established companies, they offered less potential for those big gains.
And they were also more vulnerable in a downturn. So then what were his specific criteria for finding these potential winners?
Okay, so first, he looked for relatively young companies, publicly traded for no more than 10 to 15 years.
Still in that growth phase.
Right. Second, a long period of sideways price action, a basing period, could last months, even years.
So that's like that period consolidation before the breakout.
Exactly. Third, a clear breakout from that base to new all-time highs. That shows real momentum.
Okay.
Fourth, the 52-week high had to be at least double the 52-week low.
So it had to have that potential for big price swings.
Right. And then finally, this was key, he looked for what he called a 24 mover.
A 24 mover.
Yeah. That's a stock that goes up 20% or more from its most recent breakout high, and it does that within 4 weeks or less.
Wow, that's a fast move.
It is. And importantly, it can't fall back into that previous price range.
So it's like it's breaking out and it's not looking back.
Right. He called it the game phase of the stock. And he said that usually only happens once in a stock's lifetime.
Oh, wow. So it's a rare event.
It is. And he wouldn't even consider trading until he saw at least 2 of these 24 movers from different industries.
So he was looking for confirmation that it wasn't just, a fluke, that something bigger was happening.
Right. And once he saw those signals, then he would do these small pilot buys.
Small pilot buys.
Yeah, just tiny purchases.
To test the waters.
Right. Because if he was right, those positions should start going up pretty quickly. And importantly, they shouldn't drop below his buy price.
Oh, so it's like, you're dipping your toe in the water before you jump in.
Exactly. And of course, the stop loss, that was absolutely essential.
Well, yeah, to protect your capital.
Right. But it was also a way for him to know if he was wrong. If that stop loss got triggered, he knew something was off.
Right. It's like a built-in reality check.
Exactly. And with those 24 movers, he had a very specific way of using the stop loss. Once the stock made that big move, that 20% jump, he would immediately put a sell stop at his buy price.
Oh, so if it came back down to where he bought it, he was out.
He was out because he figured if it was a real uptrend, it shouldn't be coming back down like that.
So those 24 movers, they were kind of like his leading indicators for the whole market.
Right. And psychologically, he wanted to train himself to expect that these stocks, after that big move, they shouldn't be going back down.
Okay, so then what about volume? How did Boyd view volume?
Oh, he thought volume was incredibly important. He said it was just about everything.
Really?
Yeah. But he cautioned against, seeing something that is not there in the volume patterns.
Oh, right, because we can get biased. We can want to see things that aren't really there.
Exactly. And he analyzed volume from the top down, starting with weekly charts, then confirming on daily and monthly charts. And he said, volume, it's always relative to the stock's average.
Right. So you got to compare it to what's normal for that stock.
Exactly. So for a big...
So even though these principles seem, pretty straightforward, I imagine it's not always easy for people to actually follow them.
Oh, absolutely not. Boyd saw this firsthand. People, they want action, they want results, and they want them now.
Instant gratification.
Yeah. And there are so many, beat the market schemes out there that just distract people from what actually works.
Right, the shiny objects.
Exactly.
Yeah.
And he also noticed that, true humility, that's rare when it comes to actually sticking to a trading plan.
Because our egos get in the way.
They do. And he contrasted that with all the, the talk, the cliches you hear in the media.
All the noise.
Yeah. And he kept coming back to this mistake that people make, trying to catch a move before it starts, trying to catch the bottom.
Oh, yeah, trying to time the market perfectly.
Right. She said, don't do that. Wait until the move has definitely begun.
Okay, so what about, those momentum traders, the ones who, they just buy a stock because it's going up?
Well, Boyd said it depends on your goals. If you're after small, quick profits, that might work. But if you want the big bucks, you got to be more patient, more selective.
So, speaking of selectivity, what about, the industry sector that a stock belongs to? Did Boyd think that was important?
Oh, absolutely. He preferred stocks that were leaders within strong industry groups.
Okay.
He wasn't so keen on the leaders in weak groups unless they had like a near monopoly.
Makes sense.
And he couldn't understand why people were so drawn to those, complex schemes when there were these simple winning strategies right in front of them.
Right. Sometimes the simplest approach is the best.
Exactly.
And what about fundamental analysis, like earnings? Did Boyd focus on those?
He believed the market's all about the future, and only anticipated earnings matter. Not the past, not even the present.
So it's about what people think is going to happen, not what's already happened.
Exactly. And to limit the number of trades he made, Boyd insisted on seeing unusual volume at the point of a breakout.
Unusual volume.
Yeah, he meant volume in the first hour of trading that was equal to or greater than the stock's average daily volume.
Oh, wow. So that really narrows down the possibilities.
It does. It automatically limits the number of trades.
So, there's this debate between, the chart readers and those who focus on economic indicators.
The fundamentalists.
Where did Boyd fall on that spectrum?
He was definitely a chart reader.
Really?
Yeah. He believed in charts and technical analysis. He said his own experience proved that proper chart interpretation, that was the key.
But what about all that research that the big firms do? They have all those resources.
Well, Boyd said the average investor, they can't compete with that. They can't out-research Wall Street.
Right.
But they do have one advantage.
What's that?
They can sit in cash. They can get in and out of positions quickly without moving the market.
Right. They're more nimble.
Exactly.
Yeah.
Whereas those big institutions, it takes them forever to build or unwind a position.
So Boyd, he went back to that treasure hunt analogy, right?
Yeah. He said everyone in the market, they get the same clues.
The price action, the volume.
Right. But it's about who can interpret those clues correctly.
So some people are better at solving the puzzle.
Exactly. He talked about the smart money, the ones who are consistently right.
And then there are those who follow them.
Right. And then there are those who get tricked by the fake clues.
And he positioned the listener,
Mm-hmm.
you, as being in that second group, the followers.
Yeah, the ones who can, learn to follow the smart money by studying charts.
And he even recommended a book, right?
He did, William Geeler's How Charts Can Help You in the Stock Market.
Okay.
But he cautioned against getting too caught up in those, hyper-technical indicators.
Right, so keep it simple.
He said focus on the price, the volume, the basics.
So when you're looking at a chart, what are the key things you're looking for?
Well, he said rising prices on increasing volume, that means buyers are in control. And then if the volume shrinks during a consolidation after a price rise, that suggests the buyers aren't selling.
So they're holding on.
Right. And he talked about a true breakaway. That's when you get a big gap up in price on huge volume, and it happens after a consolidation period following an uptrend.
So it's like the stock it's launching itself higher.
Exactly. But he warned against seeing breakaways where they don't exist.
Right. So don't get fooled by, false signals.
Right. And he said these real breakaway moves, they take months to develop.
Okay.
And to trade them successfully, you often have to pyramid.
So you buy more as the stock goes up.
Exactly.
Now, what about, this idea of back testing, where you use historical data to test a trading strategy?
Boyd was pretty skeptical of backtesting.
Really? Why?
He thought it gave people a false sense of security.
Oh, I see.
Just because something worked.